Hello there, Trading Nation. Today we're going to talk about how to buy stock by selling puts. How can you buy stock by selling puts? And we're going to use an example of a trade that I put on today to show you how you can sell puts as an opportunity to buy stock. So first, let's look at the trade setup, and then I'll show you how to do it in Robinhood and show you what the risks are. And remember, every trader is responsible for their own trade. Okay, so you're responsible for your own trade. This isn't a recommendation. I'm showing you the trade that I put on today and how you can sell puts in order to buy stock. So I'm looking at this stock right here, GAN. And this is a stock, looking at this chart, that I want to buy. I've decided that I think that this is a good stock and I would be interested in buying. You see that the stock went up and now it's coming back down. Now, one option is that you could just go out there today and buy the stock at $17.95, $17.95, and congratulations, you would own the stock. And sometimes that is the best option. But in this situation, we currently are facing an overall market which is on the decline. And so I think there still might be a little bit of an opportunity for this stock to come down a little bit. But if it ever does come down, let's say for example today, if this stock was at $15 today, I would absolutely buy it without thinking. But obviously I can't buy this stock at $15 because it's currently trading at almost $18. It was a little bit lower earlier today. And so the trade that I put on today is I went ahead out there and I sold a put. Just sold it flat out. Now, when you sell a put in that situation, especially if you're not going to buy another put underneath it to protect yourself, that is what we call a cash secured put, which means that I have to have enough cash or buying power in my account in the event that that stock was put to me, at which point I would have to buy that stock. And so remember, every option is equivalent to 100 shares of stock. So in this situation, what I'm doing, and let me go ahead and pull over the Robinhood to show you the trade today that I took. Here is the trade that I went ahead and took on this stock. And you'll see a little bit ago. What I did is I sold the 17.5 put, which means that I would get to, well, I would be forced to buy that stock at $1,750. Well, $17.50 times 100 shares would be $1,750. So you have to have $1,750 in your account because it's essentially you could be buying this stock. Now you may be saying, wait a minute, you said you wanted to buy it at 15, you sold the 17.50 put. And you are absolutely correct, but if you look here, two contracts, so I did this 2 times today. So it's going to be roughly, I need to have $3,500 in my account because in the event that this stock is trading below $17.50, and this is for next week, I will be forced to buy it. Which is fine, because remember the thesis of this trade. The thesis here is that I want to buy this stock anyway. And so in order for me to do that, I sold this 1750 put. And in return, I received $1.55 per share. 100 contracts, so that means $155 per contract for a total of $310 at $17.50. So if we do some quick math, $17.50 minus $1.55 per share is $15.95. So in the event that, now remember that $1.55 is mine to keep regardless of what happens in this trade. And so in the event that GAN is trading below 1750 next Friday, I will be forced to buy it. But when you take into account the credit that I received, my cost basis is going to be just under $16 per share. Just under $16. Taking a look at the chart once again, you'll see that's going to put me right in this range here, which is a kind of a support level where, you know, that $15 to $16 range, if it comes down there, I would want to buy that stock anyway. And so now let's talk a little bit about the risk of this trade. Remember, essentially, I am obligated to buy that stock at $17.50. And so if the stock is trading all the way down here at $10, I still own it. Which, to be quite honest with you, I'm okay with in this trade, which is why I chose to do this scenario, because I actually want to start getting long this stock. And so the risk is I am responsible. I have the complete risk below $16 with the credit. And so what am I going to do next Friday if this stock is down here at $10? Well, I'm going to buy it at $17.50. So I'm instantly going to be underwater by $7.50 per share. But remember, I also collected that credit, so it's actually going to be around $16. So I will be in the hole $6. Boy, that sounds like a horrible trade. That would instantly put me underwater. But remember, that's the same risk as if I bought the stock today. If I just went out there and bought that stock right now, I would have that same risk. And so, in the event that this stock is below and say it's way down there, I will buy the stock at $17.50. I will take my shares because I want to be long the stock anyway for the long term. And I will hold that stock and treat it just like normal. Now, the other scenario would be that GAN is trading above $17.50 next Friday. What's going to happen in that scenario? Let's take a look. Okay, so if it's trading over $17.50, I will get to keep all $310. And I will not own the stock. So I win. I make some money. What will I do at that point? Now remember, this is me. Every trader is responsible for their own trades, and so this is up to you. So but here's my game plan, trying to show you what's going through the mind of a trader making a trade as I'm selling puts as an opportunity to hopefully buy this stock. And so if it's trading over $17.50 next Friday, I will not own the stock. But I will have $3.10 to my name. I will plan on taking half of that, regardless of what the stock price is. I will take half of that amount that I collected, which is earnings. I will take half that amount and I will instantly buy stock with it. However many shares of stock I can buy. Basically, that's, I won't call it free stock because it's my money, but it's stock that I'm buying by collecting this premium. And so I'm fine if the price goes higher. And if the price comes down, I'm fine with that too. Ideally, this stock will be trading somewhere right at $17.40. Because in the event it's trading at $17.40, I will buy it at $17.50 and say, wait a minute, that's not a good trade. You're going to be 10 cents down. On the stock, you're correct. But remember, I collected $1.55 per share. And so that puts me at $16. So I will have essentially paid $16 for a stock that is currently trading at $17.40. And so this is one of the reasons that I really enjoy selling puts in order to help me get into a position that I want to own the stock anyway. Essentially, there is no outcome as of next Friday that I am not happy with. If it goes up, I missed out, but I wasn't real comfortable buying it right now, and I'll collect the money. And I'll use that money to buy shares. And I'll look for an opportunity to do this again in the future. If it's down below, that's a risk I'm willing to take because I'm fine holding this stock, at which point I will hold this stock, and I'm going to sell some covered calls against it. And we'll start whittling away at that loss, and I'll make another video to show you how to do that. And so that is one scenario in which you can sell puts in order to essentially buy stock. I hope that helps. If you have any questions or something wasn't clear on this, go ahead and put a comment below. If you also enjoy selling puts in order to buy stock, let us know about it. Let us know how it works for you. Until next time, everyone. See ya!